All right, folks, welcome to the Property Couch, and I've got a very special guest with me today. Her name is Nerida Conisbee. She's the Chief Economist of the REA. She joins us every month. Welcome back to the Property Couch, Nerida.
Thanks for having me.
It's a pleasure. Hey, listen, excuse the croaky throat. I've been tested. I don't have coronavirus, but I've obviously got a tickle in my throat. Hey, it's been 4 weeks since we last chatted. The last time I chatted to you, I said, gee, a lot happens in 4 weeks, but a fair bit's happened again in 4 weeks. What do you make of what's happening right now at a sort of a 30,000 foot view?
Yeah, look, I mean, things have turned out to be far less negative than I expected. The first 2 weeks, basically we went into lockdown mid-March. What we saw on site was initially a big drop-off in both buyer and rental search. Since then, that's both gradually picked up. So particularly the buyer search has really recovered. We're now seeing a 37% increase in search for last week compared to the same week last year. So buyer activity is looking okay. In terms of rent, I mean, there's a lot to talk about rent, and it was looking very bad 4 weeks ago. I think we have had a lot of federal government and state government announcements which have calmed the market a little bit. But no doubt a lot of landlords are feeling pretty strung out at the moment. A lot of renters are pretty stressed. And so, that issue probably won't resolve itself for a little bit longer. And then we've got listings. So rental listings are well up. So partly because rental demand has been weak, but also because a lot of people have been trying to move back home or moving with friends. We have seen an increase in flatmates.com.au activity. And we've also seen a lot of AirBnB listings convert to long-term listings. So that's also been an added factor to the market.
Yeah, that's a challenge too when you've got a market where that provides a bit more of an oversupply, when they generally are taking up that short-term rental market. I mean, have you? What's the observation from certain sectors? Because you get to speak to a lot of groups. I mean, is there any cross section of the community that you're observing is doing it tougher than others?
Yeah, I mean, the rental landlord issue is the biggest one. We saw the rental market get hit very, very early on, primarily because a lot of young people rent, a lot of young people are in casual employment. They're highly exposed to tourism, hospitality and education. So when we have a look at job loss, they were the areas where we saw immediate job loss and people having their incomes plunged to nothing. So, or job seeker, and then that flowed through to the landlord market very quickly. So we did then have the 6-month ban on evictions, which put everyone into a flurry in terms of what that means, and do people pay rent, and what happens there. And then we've gradually had those state government announcements made. So it does seem to be that some state governments are doing it a little bit better than others. There was a lot of concern about Queensland and that a lot of the legislation was really aimed at helping the tenant, not the landlord. So that was pretty problematic. So I think it's calming down. I think when we talk about pricing, rents will be the area that is hit the most. I mean, we talk to people who are in the market. In some locations, we are hearing of 1 month rent free. We're hearing of 20 to 50% rental reductions. People are just really trying to either keep a tenant or get a tenant. The areas we're seeing very low demand from renters is continuing to be Western Sydney, southwestern Sydney apartment market. So go across to Adelaide, and Adelaide rental demand is still pretty robust, which is quite interesting. Hobart rental demand is actually still okay, not as good as it was, but it's still okay. And then when we go to southwest Sydney, we've got this very, very poor rental demand conditions, which isn't different to what it was like before COVID-19, but it has just been exacerbated by what's been happening.
In times like this, I think everyone likes to pull out their favourite Warren Buffett quote. And one of his is, when the tide goes out, you get to see who's been swimming naked. And I think that's really important at this point in time, because during the good times, the rising tide lifts all ships. But you talked about some of the vacancies and some of the, month free vacancies down 20 to 50%. What's interesting is in certain segments of the market, medium to high rise, the units, the oversupplied apartment markets, those areas are really, really affected. But I guess we as a buyers team, we get to see it at the ground, and we're seeing what's happening. We see how long it's taking for the rentals to happen, and also seeing where the for sale signs are coming up. And I guess what's the overarching principle for us is to make sure prior to a pandemic that you've done the basics right. Because if you've bought the right asset, when a pandemic comes, it doesn't mean that you're immune to getting vacancies, but the likelihood of you getting vacancies is so much reduced. So we're obviously seeing those scenarios where people are having to create incentives. But interesting anecdote, our property advisory team, they were going through a scenario where a client had 9 investment properties, and of the 9 investment properties, 3 of them were what I would call A-grade properties, and 6 of them would be what I called C-grade properties. And the C-grade properties hadn't performed. They're the ones that were putting the most pressure on the portfolio. And therefore, as I said before, when the tide goes out, you see you can swing naked. It's times like this you see what the decisions you made at the time of purchase actually mean during a time when it's not flying. So I'm encouraged by what I'm seeing with the rentals for that type of stock, but I'm also aware that some people are doing it really tough if they're finding vacancies where they've got to give a month free rent, which is challenging.
Oh yeah, look, it is challenging, and I think I don't think you are right. I mean, if you're in an area where there is lots and lots of very, very similar rental properties, then people's ability as a renter to negotiate a better rent deal is quite different to if you're somewhere where you've got big family homes and there's not that many of them, and as a proportion of the total market, it's relatively low. So it's it is an interesting time, and I think long term property markets are always, most locations are pretty good if you hold long term. So even if you are in a difficult situation at the moment and you are struggling to get a tenant, I think ultimately what you want to do, ultimately what you want to do, you want to hold on. You want to try and get through this time period and not sell as a distressed seller, because that's where you're going to get caught out and you'll lose a lot of value. So, wait till the rental market starts to settle, wait till buyers come back, and then start to consider your next step.
Yeah, the rental market during this time has sort of been broken up loosely into 3 categories. You've got the folks that are unaffected, still able to pay their rent. You've got the folks that are heavily affected and they are doing it really, really tough. And then you've got this group in the middle, which have been opportunists, where they've said, well, yeah, apparently there's some rent offers that we can get and we should put our hands up to try and grab some of those. And I think that's been the challenge. Ben and I have been chatting with the presidents, or a number of the presidents of the real estate bodies around the country. And it's that opportunist group which is actually doing a lot of detrimental harm to the folks that are genuinely in strife, because the opportunists usually have the louder voices. So therefore they're putting their hands up and saying, I want some rent reductions. Whereas those who genuinely need help are usually doing it quietly. There's a little bit of embarrassment around that. So I think you mentioned Queensland. We were part of the campaign where Everybody Matters over the last sort of 10 to 12 days over the podcast to try and just get some balance into the fact that landlords are usually mum and dads who are trying to self-fund themselves, who are also under the same pressures as everyone else. And the fact that heavily weighting it in the favour of the tenant wasn't necessarily going to help. But the message we're trying to get across very clearly is that there are tenants doing it tough, and as a community we need to protect those. It's that group in the middle who are, we had anecdotes where someone wanted a rent reduction and they had $10,000 in the bank, and they said, well, I don't want to use that because I'm going to spend that on a holiday, right? So that's challenging versus someone who's lost their job, the household income's been really negatively affected and they genuinely can't afford to pay the rent. And being able to decipher that in the message has been a challenge for everyone.
Yeah, and look, it was a real challenge, a really challenging policy issue. I mean, it was that, we basically had the 6-month ban on eviction put out there, and really no certainty as to what exactly it meant, and what it meant for landlords. Obviously it was good for tenants, but I think it has been interesting how the state governments have reacted, and getting that balance. Like as you said, it's just so important that you're not dealing with a multinational corporation who has very deep pockets and can handle shareholders okay. You are dealing with people that also could be potentially have lost their jobs, or we're definitely seeing reduction in income. So it was a very, very hard balance to get right.
What's your take on the property market sort of in for the remainder of the year? And I know that's a generalised statement and it's very difficult, but probably more to the point, are you able to sort of dive into any sort of segments that you see, whether it's the owner occupier appeal style properties versus the investment stock style properties, and are you able to sort of give some indication on making sense of what's happening in the property market, and for those people who are keen to work out if our values are going to drop 40% or whether they'll just have a coronavirus correction that might come out the other side? What's your views on that? Notwithstanding, it's a very general question I'm asking you.
Oh, look, I mean, 4 weeks ago, I was feeling far more negative, and the fact that we haven't seen a huge drop-off in search activity does give me confidence that, at least from a buyer's perspective, there are a lot of people out there looking. So whether they're looking to find a bargain or whether they're just looking to because they've got their market activity and there's just a bit more buoyancy in the market than we expect. We obviously don't know. I know a lot. The very negative forecast. I mean, there are a lot of people predicting a 30 to 40% drop, but I mean, to get to that level, it has to be. I mean, you do have to see massive rises in unemployment. So one of the examples of a very bad residential market is Japan. So Japan, you've got locations where people abandon homes. They're worth nothing. They can't sell them. They can't be bothered paying taxes. They just basically get up and go. But over the same time period, we've seen Tokyo continue to see pretty good price growth. And so, at a worst case scenario, that's kind of what happens. You've got declining population. You've got a pretty poor performing economy. It's very long term. There's kind of nothing. You've got monetary policy that has been trying to stimulate the economy for decades. And you've just got this general decline in activity. In Australia at the moment, what we're seeing at the moment is rental crisis, and it is landlords that are affected. I think one of the positives for landlords, though, is although they are losing income, there is this 6-month mortgage payment freeze being offered by most banks. So, and that's for owner occupiers as well. So fundamentally, if you own a property at the moment and you lose your job or you lose income because your tenants can't pay their rent, you are getting protected, at least for a short time period, against having to be a distressed seller. Because you can imagine now, if you've got your mortgage, and we know people, particularly in Sydney and Melbourne, are highly indebted and their mortgage levels are very, very high. If you lose your job, you can't pay back your loan. There goes your property, and then you have to become a distressed seller. And if we start to see a lot of distressed sales, that's potentially where we would see this massive decline in pricing. So at the moment, we're not seeing distressed sellers. We can see it from our listing volumes. They're certainly not increasing because people are just having to get out and take a hit on their property's value. We are seeing banks offer these mortgage freeze products, which are helping a lot of people just continue to own their properties and stay in their properties. But there will be some markets affected more than others. So I think, from what we can see from every measure that I look at, whether it's inquiry or listings or search or rental demand, we look across a huge range of measures. We can see that Canberra is holding up really well. So, while everywhere else has been dropping, Canberra hasn't dropped at all, and it's actually increased. And it's even increased in terms of listing volumes, which is quite extraordinary at the moment. I mean, people don't like to sell with this much uncertainty. So Canberra's doing really, really well. We are continuing to see, I guess, what you would call A-grade properties in capital cities do okay from a buyer demand perspective. They may see price declines. I think it would be naive to think that they wouldn't when you can't see this massive, very quick uptick in unemployment and not expect prices to drop a bit. But I do think those suburbs will be protected a little bit more. But then looking in other parts of Australia, somewhere like Hobart, which has been my absolute favourite for ages and ages. It is an economy that has been driven by tourism, been driven by hospitality, it's been driven by education. So you've got 3 sectors of the market where things are going badly. They've got, their COVID outbreaks are worse than other locations. You've got a lot of Airbnb listings converting to long-term listings, rental listings. So suddenly you've got this big uptick in volume of rental properties, which is actually not a bad problem for Hobart, they do black rental properties. But it is a very different market to what we're seeing in Canberra, which has been, 42% government employment, in direct government employment, and then off the back of that, more companies relying on government employment, and they're seeing very, very different conditions. So I think that they're the two. You've got one market that does look very protected, and another market which is very vulnerable.
Yeah, because it's a challenge, right? Because I've had you and I arguably have a vested interest in saying property is going great, right? You obviously have, you're an economist of a listing site. We have a business that revolves around buying property. So some of the feedback that we're getting from some people in commenting in socials is, sure, of course you're talking it up, and because you've got a vested interest. But I think using the Japan example that you said before, I think there's a few fundamental differences. We have a very large population growth, and we're not building enough properties generally to cater for that growth. And that really helps to underpin what our story was. The property story going into this was very strong. And clearly, I would be lying if, our buyers team are buying properties for 5-10% less than what they would have had to pay prior to COVID. That's without a shadow of a doubt. But I see that as being a mindset thing where people are out of the market, we're a professional buying team, we're comfortable with what's happening. Because I don't necessarily see on the other side that we have this racing return to boom-like conditions. But I also find it very difficult to see, even trying to be as independent as I possibly can, to see that the prices, they have to water has to find its own level again. And if the tide has gone out a little bit, or a temporary dam has been put in place, as soon as you let the dam go, the water starts to flow again. And I'm not suggesting that it's going to rise, heavily past where it was pre, but it's just very difficult to see, even if you're trying to be a little bit pessimistic, to see how the market in what we would call investment grade assets won't have that performance being underpinned. And I guess we've got to take that criticism because we do have a vested interest, but we're trying to back it up with facts.
Yeah, it's interesting. I mean, I get the same criticisms, but one of them was that I was being too positive. But literally, the way I was feeling about the market the first week that followed COVID, it was, I didn't come out and say we're going to see a 30% price drop, because we literally had no idea what was happening. But I was feeling very negative about what was happening, and it was very hard to think of anything positive to say. But I think it has surprised me, the level of activity on our site. I think what I saw the first 2 weeks in terms of this massive drawback in activity, if we didn't have a government that was very committed to trying to help us through this, so we didn't have this launch of 16.4% worth of the GDP stimulus pumped into the economy, I think we would have been looking at quite a vastly different conditions. Also, the fact that we do seem to have been pretty good at getting infection rates under control. I mean, I looked today, and New South Wales yesterday only recorded two new cases, and that was off the back of record levels of testing being undertaken. So, I think we have, if we can continue to keep that level of infection under control, I think it is going to lead to a vastly different situation for us. The other part of it too is, Australia is seen, or it has historically been seen, as a safe haven. We haven't gone into recession for a very long time, and that's globally a record across the world. So we are a place that people want to be in, and we are an economy that does continue to do well. So I think those fundamentals around property do support the fact that prices probably will drop. But to see 40%, I mean, to get to that level, it has to be so diabolical. You'd have to see so many distressed sales in the market for them to drop. And there's no way you would have people searching for property if prices were going south by 40%. I mean, they're conditions where people do not want to buy property under any circumstances. And there is something seen as inherently dangerous in buying property. It's like buying shares in an airline or something, you know, like
Yeah.
you can buy shares in an airline at the moment because, you know, there's very little positive news for international travel, but for property, you know, we're still seeing this activity, which suggests that people are still very, very interested.
Yeah, well, you touched on the impact that it has around the world. You talked about Japan. What can we draw on from some of the experiences that we are seeing around the world that you might use to draw comparisons and strength or pessimism around how you see Australia responding?
Yeah, I mean, it's interesting. The data's not that great at the moment, obviously, because it really only all kicked off on a large scale, probably, you know, early March, mid-March. So if you have a look at one market, Italy, Italy was having northern Italy in particular was doing particularly well up until probably the end of last year. There was some record numbers coming through there. You know, again, the data is a little bit all over the place. I mean, there was one claim that rental levels actually had increased over March, which, you know, was a little bit hard to believe. But I mean, we're not seeing reports of catastrophic collapse in pricing. I think Italy will be a little bit different following this. I mean, they've gone into this crisis with an economy that's not performing that well, and then also a very poor performing banking system. So one of the things that will underpin our recovery is the fact that our banking system is solid, which Italian banks have been crumbling for, you know, a long time now. So that's a problem. If you go somewhere like New York, again, what we could see quite different conditions to here, primarily because they did put a ban on live inspections. So you actually couldn't go and look at a property. You could do it by video, but you couldn't do it personally. So the luxury market collapsed very quickly. In the most recent week, there was only 4 million plus sales, and that was comparable to what happened post September 11. So New York, very hit, but very locked down. So I think, you know, that's a different market again to Australia, because we haven't been locked down to that same extent. The UK, again, they didn't really see, they also had a strict lockdown, so no inspections and property. They were actually banned from moving. People weren't actually allowed to move property for over a 4-week period. And then, of course, very, very high levels of COVID-19 infections and very high levels of death. So, you know, that will take a hit. But again, they didn't see such a drop off in listing volumes, so which was a little bit interesting. But I think their model's a bit different, in which you know, there's still, you know, incentive to list, but a very sharp decline in transactions taking place. So listings held up, but there weren't many transactions. So we are, you know, I am continuing to look pretty closely at what's happening overseas, but at the moment the data is a little bit light on, and a little bit hard to kind of understand what's happening when things are so bad.
Well, it's when you do that fly around, you get a bit of a sense of why Australia has got some, you know, the property fundamentals are great. We have a banking system that has recourse lending, not non-recourse lending. We have a beautiful climate. We're politically stable. All the things we've talked about. We're a food bowl here. There's so many things that make us punch above our weight in terms of, you know, we're the 14th largest economy in the world, and yet with only 25 million people. Some of the economies above us, of, you know, America at almost 400, you've got China and India over 1 billion. There's just that resilience that comes from our economy. So it's when you reflect on some of those markets around the world where you go, okay, the banking system's different, or the population is different, or the way they transact is different, which really still fuels the optimism that I have in our fundamentals of property around here in Australia. Hey, can we avoid a recession if it's defined by 2 quarters of negative GDP growth? And if March is positive and clearly June will be negative, is there a chance that we can technically avoid a recession?
Yeah, look, I think so. I mean, if you have a look at, I mean, the March quarter won't be negative. It'll be positive because this didn't kick off until mid-March. So, you know, we can see it in house prices were pretty good in March. We saw our listing volumes were looking amazing in March. So, and then you look across a range of other indicators. It was showing that at least on a 3-month time period, 2.5 months of great economic, or, you know, far better economic growth would lead to a positive outcome. I think the June quarter will be, I don't think it will be looking really bad.
Yeah.
So, I mean, you
I think
can't,
that's a given.
yeah, I mean, you can't add that level of unemployment to the economy and the hit on productivity and, you know, not have this pretty terrible impact on growth. But yeah, September, I mean, we could, you know, it probably won't be a great 3 months, but, you know, I don't necessarily think we will see it back to normal, as you were saying. It's not going to just suddenly return to exactly how it was, but quite possibly if we do start to see an end to this lockdown in the next couple of weeks, if people can get back to work again properly, you know, we will see a vastly different situation in the September quarter than perhaps we would have otherwise seen if we had seen this quite serious number of cases occurring across the market, across Australia.
Yeah, okay. What about first home? A couple of trends that we're seeing on your site. First home buyers, I mean, the conditions would arguably be great for them in terms of a little less competition, a little bit less pressure on price, but it's also again played above the shoulders for a lot of first home buyers because they could be scared or spooked by what's going on. What activity are you seeing around first home buyers in the market?
Yeah, I mean, first of all, it's interesting. I mean, they hate certain conditions. They hate very fast-moving conditions. You know, when we see very fast increases in pricing, we just don't see them transacting as much. They also hate in markets where there's lots of investors. So if they're at an auction, for example, and there's a lot of investors there, that's another sort of condition that they don't seem to really enjoy. At the moment, investor activity has pulled back dramatically, you know, not surprising with what's been happening in the rental market. But so, you know, that's not a competitive issue for them at the moment. We've also got, one other thing that, a few other things they really seem to like are incentives, obviously. So we have seen the Victorian government extend their regional incentives for first home buyers. We've still got the 5% deposit scheme, which has been incredibly popular. And what we were seeing in January and February was some very, very strong pickup in first home buyer inquiry levels. So inquiry on our side is clicking on a listing and sending an inquiry through to an agent. So it's better than we can get information about buyers through that process if you can specify what sort of buyer you are. So that showed in March some very good, or not bad conditions compared to February, compared to other buyer groups. So investors dropped off by about a third, but first home buyers dropped off about 20%. But what was interesting about the first home buyer drop off was that it was still up in March compared to the previous March 2019. So even though they dropped off February to March, they were still up from March 2019. So they're not gone. They're certainly not gone. I mean, no buyer group is gone, but they haven't been as affected as we've seen other buyer groups.
Yeah, well, as I say, it'd be interesting to see if they can see an opportunity. But hey, how's the appetite been for you guys? Pivoted pretty quickly in COVID environment to allow uploading of walkthrough inspections. What's the appetite for your user base for consuming that content?
Yeah, it's been great. I mean, digital inspections was something we launched very, very quickly. So it was timely, but obviously it had been in development for quite some time. So it's been incredible. I mean, what's been incredible, it's not just we're not just seeing digital inspections being very, very popular amongst properties for sale, but also properties for rent. And it makes sense. And if you're looking at 10 properties to rent or 10 properties to buy, being able to do a digital inspection does help you narrow down the list of potential properties quite quickly, because you do get kind of that walkthrough that is quite hard to sort of envisage for a lot of people. The other thing we have launched is online auctions. So again, that hasn't had as great a take up. And we have a look at the conversion from live auctions to online auctions. Last year, for example, 15% of properties around Australia were sold by auction. If we have a look at online auctions, which are fundamentally a different process, so they're not really comparable, but we're only seeing 5% of properties sell by that process. So it hasn't been as popular as what we've seen digital inspections have been.
I think that'll take a bit of time. I think there's a bit of awareness around online auctions. I don't think that's an overnight thing. I think people have to build a bit of trust around what that looks like and for it to be more accepted about, you know, people who are on the street seeing who they're bidding against. So I think there's a bit of work to do, but I think that'll slowly gain a bit of momentum over time as well. We've been using walkthrough inspections for our clients for many, many years now, and it's been something that they've really embraced because it's a bit more rough and raw and ready. So I guess from the buyer's perspective, it's been really overwhelmingly positively received. It's just whether or not the buyer trusts one that's been uploaded by a listing agent who's acting on behalf of the vendor. That's really the bit that we'd like to pressure test. And you probably can't find that data out because all you can do is see who's watching them versus who's trusting them. So
it's funny you say that because at the moment, I think because a lot of people have had to pivot, a lot of agents have had to pivot very quickly. So, you know, they've had to do, a lot of them are, not a lot, but there are, you know, most of them I think would be just, you know, an iPhone kind of just walking through the property. But yeah, I just know agents, you know, they love to present properties at their absolute best. And if you have a look at photos, you know, we don't see photos taken on an iPhone. We've always got beautiful photos taken. So I have no doubt as this evolves, we will see agents uploading incredible walkthroughs and incredible digital inspections.
Yeah, so there we go. Hey, staying on the theme of the trends you're seeing, there's some people dreaming of rural property. I think you've seen a big uptick in Wollongong and Port Macquarie and Orange and even Mildura and Wodonga. What's your take on that?
Yeah, it's interesting. We had a look at rural locations for March. So, you know, March data was starting to give us some really good information as to what places people were looking at on a suburban level and also on a regional level. There do seem to be areas that are always popular coming up there. So Wollongong does, you know, it was doing very well prior to COVID-19. So that's topping the list at the moment. We're seeing places like Berry coming up. So Berry's such a beautiful location. Byron Bay is another one that people are still looking at. And obviously that economy would have been hit very hard by, you know, tourism downturn, but people are still looking around for property. A few interesting ones. Orange is one that it has been popping up on a few different lists of late. We saw it pop up in the first home buyer inquiry, one of the most inquired locations for first home buyers recently. Investors are pretty interested in it. So, you know, it isn't a commuter town, which, you know, typically drives regional demand. It's because you can get to the capital city pretty quickly. It's, you know, 4-hour drive from Sydney, but there does seem to be enough going on in Orange to drive quite a bit of interest. Other areas, Wodonga and Mildura, so, you know, both border towns, both not relying on tourism. You know, they are quite separate economies. So, you know, they came up as well. So that might have been employment related. I'm not sure. It certainly wouldn't have been related to people, well, maybe not certainly, but, you know, probably wasn't related to people wanting to buy holiday homes in those locations.
Commercial and industrial. Industrial's probably pretty busy at the moment, isn't it? Given the fact they've got to store all the online merchandise that people are getting Australia Post struggling to deliver. So, what's your take on commercial and industrial property?
Yeah, commercial property is doing well for industrial, as you said. You know, we're seeing leasing demand hold steady. Buyer demand's pushed back a little bit, not surprisingly, but compared to what we're seeing in shopping centres and retail, which is diabolical, and hotels obviously is not a great place to be, and also office isn't too good. In office is likely to be seeing. We don't have clear data on it yet, but there would be a lot of tenants negotiating leases in the same way that they're negotiating them in the residential sector. So that's a market that will probably be hit long term because we have got a lot of people moving into working from home, which previously a lot of employers didn't like, but, you know, it'll probably become a little bit more normal. The other area that's doing well is, not surprisingly, health industry. So medical centres, hospitals, those sorts of things are seeing pretty high demand. And then also the one that is really the shining star at the moment for commercial property is rural and agribusiness. So that's a sector of the economy we're still seeing. We've actually seen an uptick in demand compared to last year. Probably more driven by the breaking of the drought. We're doing a little bit more work around that at the moment to work out, you know, whether it's potentially that, looking at it on a statewide basis, but that's a very, very strong sector at the moment and quite different. It's kind of like the Canberra of commercial property.
Yeah, even it's formed part of our discussion around the office space in terms of there was a time where we thought that all of our team needed to be together, but, you know, clearly the fact that they're all separated now. They're all working from home, and touch wood, everything's going along quite nicely. It certainly does bring in a new round of thinking. So I'd be super interested to see how the office space goes, because I think the great work from home experiment going on all around the world will really change what that looks like. A couple of last ones for me. One is unemployment rate. How can people decipher the unemployment rate? We've said on the podcast we feel it'll be made up of three categories: the genuine unemployed, the folks who have been temporarily stood down, and then the folks who wouldn't necessarily classify themselves as unemployed, except the fact that there's some stimulus money on offer, so they'll put their hand up for it. How should people read the unemployment figures? Because I think it's probably fair to say that's going to head north still. And when you've got carriers like Virgin in trouble, and AFL standing down big employees, and the NRL and all those sorts of things, have you got any advice, any frameworks, any tips on how people who are listening to this can read the unemployment figures and not necessarily get filled full of fear or anxiety, or if in fact they should be filled with fear and anxiety by the number?
Yeah, look, I mean, like most data points, I think it's important to look at the time series. So, look at the change as opposed to look at the actual figures. And that helps to deal with things like you were saying, there's different types of people unemployed. There's people that are done in the workforce anyway. You've got people who have been stood down temporarily, which, are being supported by the JobKeeper program. And then you've also got the people that have lost their jobs completely because of COVID-19. So, for unemployment, there's some good indicators out there. I mean, Seek are now publishing some pretty good numbers to see what's happening across sectors, which is really helpful. The ABS are doing weekly updates now based on some of the data sets that they can pull out. I think you're right, though. I mean, I don't think you are. You are right. It will continue to go north for some time. There doesn't really seem to be good enough conditions to suggest otherwise. But things will change very quickly if we do start to see an easing of the lockdown. I mean, if you have a look at the people that lost their jobs very, very early, they were very exposed to hospitality. So, once we start to see restaurants and bars open again and start to get into, a little bit more regular business, that will dramatically change things. You've got the fitness industry, which again was shut down very, very early. So, once they can get back to work normally, you'll start to see an uplift. The one part of the economy that will take a long time to get back to normal will be tourism, and domestic tourism will pick up quicker. Once we can all start moving around and holidaying in Australia wherever we want, that's good news. But there will be areas that are very exposed to overseas tourism that will take a long time. So. So premium hotel, 5-star hotels in capital cities are probably the main ones. You've got casinos, which are very reliant on overseas tourism. So, there's parts of the economy that will take a lot longer to get back to normal, and we don't know when that will be, because we don't know how soon we can open up our borders again.
Do you have a view on the peak number? Do you have a crystal ball where you think it'll get to a certain level?
Yeah, look, I don't know. Look, I don't know. I mean, I've been really careful putting out forecasts, because I think people have been putting out such random numbers, and when you have a look at the modelling that's been done, I mean, you've got to make so many assumptions about so many different things that you really, you may as well just pick out a random number and say what it is. I mean, when you're having a look at some of the scenario models, people are using 12, 15, 20 different scenarios to try and predict what's happening, which gives you such a wide range of outcomes that it's pretty much verging on useless. So, at this stage, I think we do. I think we're in vastly a different situation where we were a month ago. So I think that things that could have gone very, very wrong haven't. We haven't seen this incredibly high death rate we've seen in the UK and in New York and in Italy, and we're very, 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 very lucky that we were able to cut this off very quickly and not see this incredibly bad situation. We have a very stable banking system, so we don't have a financial crisis. We don't have banks going under. We don't have we don't have runs on banks, people trying to withdraw their cash in panic. we don't have a banking system which is, just can't prop up parts of the economy, which it can by offering better terms of payment and mortgage freezes and the like. So that solid banking system will really underpin our recovery. At the moment, the problems are really centred around the fact that we can't work properly, and it's really hard for a lot of people to do their jobs properly. And we've got parts of the economy that just are completely locked down, which until we're out of lockdown aren't really going to recover.
And importantly, we can all get toilet paper again, which is a significant change from a month ago. But hey, the final one for me is we get through this. People start going back to work. The cafes start opening. We can go back to the movies. Eventually, life returns to normal. How do we pay the debt back? Is it just a case of is it higher paid professional workers likely to wear the burden? Because there's got to be a levy somewhere. I'm sure the levy's not going to be in the middle to lower class, and the uber rich can move their money around tax entities. So would it be fair to say that the higher paid income earner is going to be footing the bill at some stage in the future?
Yeah, I don't know. I mean, the one I've been hearing most about is doubling the GST, and that could be quite possible that they'll just double it from 10 to 20%. So, which would, I mean, the problem is with any tax you're implementing, you're going to hurt some part of the economy. So, retail trade will take a dive because things get more expensive. So, GST is an option. As you said, income tax, company tax. I mean, they'll all be open in terms of what the government looks at. And look, and hopefully we don't need to spend as much as the government was expecting. And, I think the federal government Scott Morrison was pretty sensible in saying, look, this is a 6-month shutdown. We all went into shutdown with no end date, which, at the time felt terrible because, it would have been good. It would have been far more comforting if you said 4 weeks. We're going to shut down for 4 weeks and we're reopening again. But I think it did lead people to think, well, this is long term, and if we open earlier, it will be a good thing for us. And so hopefully confidence does pick up pretty quickly from there.
Well, as always, appreciate your insights, Nerida. I'm sure that your views are being sought by very far and wide, and each and every month you come onto the Property Couch and share your insights with us, to which we appreciate that. So, Nerida, thanks for coming on the Property Couch.
Thanks for having me.